Good morning, everyone. Happy New Year. Adam, Happy New Year. My name is
Happy
Zach
New Year.
Hurst. Thanks, Zach Hurst. I'm with the Trust Company of Tennessee. I am in our Chattanooga office. I'm joined by Adam Davies, Vice President of Retirement Plan Services out of our Knoxville headquarters, and we are excited to be here. Adam, we have not gotten any better looking in the new year, but boy, do we dress well.
I was just thinking your sweater looked nice, Zach.
Yeah, this is a little embarrassing. We're gonna have to make sure this doesn't happen again, but excited to be back with you. Many of you on this call have probably. And by the way, you're expecting more than 500 people today, so this is wonderful. We really appreciate the response to this big legislation that passed over the holidays. We were trying to relax and enjoy our time, but instead we got hit with this. But it's mostly good news that we're going to cover today with Secure Act 2.0. Let me set the stage on just a couple of things here. We've got a wide range of audience here. We have individuals, we've got accountants, attorneys, plan sponsors, and for those who don't know, a plan sponsor is somebody typically in HR or a CFO role who's going to handle the administration duties of a 401k plan within their company. So this is going to impact all of us in some way. I say all that to say that sometimes I might mention a plan sponsor. I want you to know who that is, but all of these topics that we're going to cover do impact all of us as individuals as well. So with that, we got a couple of little housekeeping items. Number one is some of those professionals we talked about do qualify for continuing ed credit. We have two offered today. That is CPE and SHRM. So we do have three poll questions as we go through the webinar today. Make sure, especially if you're want credit for this, that you're answering all three of those, and they're fun, so everybody answer them anyway. And the second thing is we have a questions box. I think my screen is different than yours, but you'll see on your screen you have a questions box to where you can enter questions as we go. We'll do our best to tackle those as we go, but we'll leave a little bit of time at the end to be sure we cover those as well. So, Adam, I think I have covered what we need from the housekeeping standpoint. I don't want to spend a whole lot of time on our faces. So what I'd like to do is, before I let you introduce what we're talking about today, launch poll question number one. We've got Joanna behind the scenes who's going to do that for us in just one moment. And it is opening as we speak. At least it says so on my screen. And Adam, do you see the poll open on your screen?
I do. How
Okay, can
many
you read that off?
provisions in Secure Act 2.0 impact retirement planning? We've got a pretty wide range here, all the way from 17 to 92.
Well, if it's 92, we're not covering all of those in great detail today, are we?
We'll wait and see.
That's right. We'll be out of here by dinner time. But it's a Adam, even you and I as late as last night, we're going through this trying to see what else was out there. What else do we possibly miss? It really does cover a lot, and it covers a lot within the retirement plan space, as well as IRA space and some other things. Adam, I do not have access to the poll on my screen, which is totally fine. But if you'll just let me know when that closes,
I sure
we
will.
can. Okay, thank you. And I'm excited about this. We've been kind of teasing Secure Act 2.0, gosh, for the last almost year, it feels like. Am I wrong on that, Adam?
You're not. No, we've covered it a lot, and we'll cover the timeline here in just a second. So I
Excellent.
did get the answers back. Looks like we have the majority of people thinking about 43 provisions, and many of you might be surprised to know it's actually 92.
And we will not cover all 92.
I promise we will not cover all 92. We just have the 1 hour today.
That's right. So we'll get through this as fast as we can for you on that. But again, many important topics here. So before we start introducing each of those, not all 92, but the key ones here, Adam, tell us how we got here.
Yeah, so I've heard many people say this is the most impactful retirement legislation in the last 15 years. Some have even gone as far to say as it's the most impactful since ERISA was passed in 1974. And so if you look at the title of the legislation, Secure 2.0, that's really building off of Secure Act 1.0, which was passed in December of 2019. And it was so popular that you can see Congress pretty much got right to work and introduced a second version of it as soon as May 2021. And so it's taken different forms in the House and the Senate. There was the Helper Act, the Rise and Shine Act, but all of these eventually got kind of combined together into what we know today as Secure Act 2.0. And so, Zach, you're right. You and I have been talking about this quite a bit, most notably when it passed the House of Representatives in March of 2022. It actually passed by a vote of 414 to 5, which is pretty crazy to think that we can get that many congressmen and women on the same page. But I'm glad retirement reform is, what they're passionate about. And so it kind of sat idle for the last couple months. We've been talking to clients, different groups about it, but pretty quickly it got attached to the omnibus spending bill that went through towards the end of December and was signed into law on December 29th. So there's a lot of provisions, like you said, some that'll impact individuals, some that'll impact just retirement plans. And so what we're going to do over the next couple slides is show you, what impacts who, and then there's a variety of timelines. So some of these are going to be effective immediately. Some of these are going to be effective 10 years into the future. And so we're going to have those dates so you can kind of keep a track as we go along.
Yeah, and you did a great job of highlighting those on the titles at the top. We're going to start with, we've really got two sections here. One is changes applicable to individuals, which is pretty much all of us on this call. And then the second section is going to be more towards retirement plans, which again is probably most of us on this call. So I think it captures the wide audience that we just referenced. And Adam, with that, let's jump into this.
Sure, and Zach, you're a certified financial planner. I know you work a lot with individuals. So tell us how Secure 2.0 is going to change RMDs, even beyond what happened in Secure 1.0.
Yeah, so Secure 1.0 took us from the age 70 and a half up to age 72 in terms of when RMDs began. By the way, RMD is a required minimum distribution. Many of us participate in 401k plans, and historically those have been what we call now a traditional 401k, where you're getting tax advantages every year you put it in, and then that growth is tax deferred and you're taxed at your income level in retirement. So that changed from age 70 and a half to 72 as to when you have to take it, and you have to take it because the government at some point wants that money, that tax money, right? So we got that passed a couple years ago with 1.0. This is going to further delay these RMDs. So you're looking at the bullets here. Beginning in 2023, age 73 is now the new RMD age, and then 2033, age 75. So I've gotten a lot of questions about this one of, is the new age 75? And I've also gotten questions about, aren't there like 3 or 4 tiers? Adam, there's been a lot of different, this seems to be one of the more popular parts of the bill. There's been a lot of different versions. This is what they settled on, but I think there's been a lot of confusion out there because of how much has been presented.
Definitely, and the draft form of the legislation, there was actually a middle tier where by 2030 you'd have to start taking it by 74. So that eventually got cut from the legislation. Simplicity could be better, but you can see it has been a popular provision, and so right now we have the 2 additional tiers beginning at age 73 and 75.
Yeah, and then you'll see the final bullet. It says reduces penalty for failure to take RMDs. That's a significant penalty, right? 50% if you forget to take your RMD. Thankfully, we work at a firm that has a lot of systems and processes to where that doesn't happen, and those are taken care of for our clients. But if you're at a larger firm who doesn't have those same parameters in place, you can really be impacted by forgetting that RMD. So none of us want to pay 25% or even a 10% penalty, but I am glad to see this drop it down a little bit.
And Zach, one of the most common questions I've seen raised is, let's say you turned 72 last year and you're turning 73 this year. Do you still have to take your RMD for last year, when you were 72 and those rules were in effect, or can you delay that further now with this new legislation?
Good question, Adam. So if you turned 72 last year, the requirement is that you take your first RMD based on Secure Act 1.0, that you take your first RMD by April of this year. Okay, so that still holds true. So anyone who qualified, if you will, for the RMD at the age 72 in 2022, you still must take that this year. And a good question.
So next we have some changes coming to Roth, and you can see this is a big theme as part of Secure 2.0. Perhaps Zach, you can elaborate on why the government likes Roth so much, and what's going to be changing in terms of employer contributions.
Well, the government likes money. I know that's breaking news here, but so Roth and traditional. Let's take a quick step back here. A traditional IRA or traditional 401k, that's again where you're getting the tax advantage each year you take it out, right? So if somebody makes $50,000 a year and they put $5,000 into a Roth vehicle, either of those, then as far as the government's concerned, they made $45,000 of taxable money that year. Okay, same scenario with a Roth. You've got $50,000 of income. You put $5,000 of that into a Roth vehicle. as far as the government is concerned, you still made $50,000, okay, even though you've put that money away for retirement. So what you're doing, and I'm a huge proponent of Roth, what you're doing is you're saying, I'll give up my this year, my right now tax advantage in favor of years and decades of growth that's going to come out tax free in retirement. Right. So I, the person, like it because I think that that outweighs the individual annual tax advantage. The government likes it because they're still getting the tax dollars on that. So this is kind of taken it to the extreme. I preach Roth. Adam, you're tired of hearing me talk about Roth, I'm sure, after our zillions of webinars. But this is even tough for me, right? To fathom paying money on money I don't actually even hold at any point. So right now, employer contributions, we just talked about how that's treated from a Roth standpoint. So employer money that comes in, if you have a match, if you're fortunate enough to have a 401k match, my money, if I choose Roth, is going into Roth. My company's money still has to be taxed to me at some point, and so that's going to come into a traditional bucket. Okay, so I've got really two things behind the scenes that I'm dealing with in terms of how that's going to be treated. What I can elect through this act is I can say, instead of my employer money going into that traditional bucket, I can say I want that employer money to go into my Roth bucket and grow tax free. And I'll go ahead and pay the tax right now on that employer money that's coming into my plan. So, Adam, as big of a proponent of Roth as I am, as big as of a fan as I am, I don't know if I'm willing to pay that tax. That's taking it to a pretty big extreme, but there might be some who do. So for the plan sponsors on this call, and for those who joined us late, we've got a range of audience here. A plan sponsor is somebody who works with their 401k plan for the company and is responsible for that administration. This is something that you may allow, not must allow, but may allow beginning in, thanks for the title, Adam, 2024. Adam, anything I missed on that?
No, the only thing I would add is that, this legislation was passed so quickly. What a lot of providers and even individuals and companies are going to need to figure out over the coming months and years is, how do you operationally execute on some of these provisions? So I imagine this would require a plan amendment. So more to come in terms of how you actually execute on this. But at the end of the day, it's giving employees a little bit more choice. And you're right, Zach. I think some people might not want to pay those taxes up front. There might be some that do. So at the end of the day, more choice probably isn't a bad thing.
That's right. And by the way, these topics are confusing, right? I mean, we deal with it every day, so we're in it. But this is something that can just really confuse people. So for those plan sponsors, for those individuals who are part of a 401k plan on this call, make sure you have that advisor or that resource that's there with you, talking you through this.
So we're going to be continuing our Roth theme here, and there's going to be some changes to catch-up contributions. Can you walk us through those, Zach?
Yeah, sure. So currently, catch-up contributions can either be pre-tax or Roth, as we just talked about on this. So a catch-up contribution is going to be for somebody who is 50 years or older. And what the government tells us is that because we're getting closer to retirement at that point, we can start putting more money than what's allowed for those who are under 50 into a plan. So right now, that's $7,500 that we can do in addition to. So if you're a part of a 401k plan, you can put up to, Adam, make sure I don't mess this up, in 2023, up to $22,500 into a plan.
You got it.
There you go. If you're 50 plus, it's another $7,500. So you can put a total of $30,000 into that plan. So as you see on the second bullet here, for retirement plans only, catch-up contributions must be Roth if income is greater than $145,000 in the prior year. So again, the reason why is that money is going to be taxed. And so, Adam, I think you do a really good job. You did in 1.0 and now 2.0 of really identifying there's so much that's being given to us as opportunities here, but the government needs to take some as well. And this is probably one of those categories.
It is, and if you have to have a gotcha where the government makes the bill revenue neutral, this probably isn't that bad of one. But I am curious how they landed on the $145,000 threshold. That's not the definition of a highly compensated executive. It's not a round number like 100,000. But what you're going to see throughout this legislation is there's several different thresholds, so much so that I think it can get confusing. And so this is where you're really going to need to rely on either your advisor if you're an individual, or your providers if you're a retirement plan, to help you know which limits apply to what provision, because there are quite a few in Secure 2.0, and I think it could get confusing after a while.
Yeah, it can, and that's going to be on, hopefully companies like us who are those providers to kind of set up some sort of parameters and stops to identify, help these plan sponsors identify what this is, because it's going to be a kind of a tedious task. Moving on
Awesome.
to RMDs, Adam.
Yeah, and we've already covered RMDs a little bit, but this one is more of just a housekeeping item, cleaning up some different rules between vehicles. So Zach, can you walk us through what that looks like?
Yeah, it's pretty easy. So right now, the Roth 401k has become pretty popular, Adam, in the last 10 to 15 years. Is that fair to say?
Oh, no doubt.
Okay, yeah, and it's something where it's almost being required. Well, there's been talk of it being required, but anyway, a Roth 401k has become more popular. Within a Roth 401k, we talked about RMDs, and again, those who are late to join the call, that's a required minimum distribution, a time when you must take a distribution from your retirement plans or your IRAs. So before this act, a Roth 401k still qualified for required minimum distributions, meaning even though I'm a big proponent of Roth and I wanted to sit there and grow forever, I've got to start taking it if it's part of my 401k plan. This is different from IRAs because I don't have to take a Roth IRA required minimum distribution at any point. And so what this act does is just marries those two, and now the rules align with what our IRAs have been in the past. So no longer, Adam, do Roth 401ks qualify for RMDs.
And there's really no need for them to be paid because the government's not recognizing any extra taxable income. So I think it's smart that they aligned these rules just for simplicity. But Zach, one of the common questions I get is, I know there's income limitations in terms of can you contribute to a Roth IRA or can you not? Do those same income limitations exist on the 401k side?
Good question. They don't. And that's the big advantage of it, because those limitations are pretty strict in terms of who can and cannot contribute to a Roth IRA. So, those who do believe in Roth, but they might be higher income earners, are able to contribute to a Roth 401k regardless of that, which is a big advantage of them. Adam, before I go to the next one, we've had a few questions pop in. So let me just venture over to this box. And how does Secure Act 2.0 affect inherited IRAs? I don't know, Adam, that this act actually touches that category, but I'm glad to elaborate on what has happened with them in the past year, but make sure I'm right on that.
Yeah, Secure 1.0 really changed some of the rules in there, eliminating the stretch provision. To my knowledge, I haven't seen anything impacting inherited IRAs in Secure 2.0, but Zach, perhaps you can elaborate if you know of anything different.
Sure, yeah. So what's happened with nothing different on 2.0, but what happened in the last couple of years with inherited IRAs is any non-spousal, there's a couple of different categories, but for the most part, any non-spousal beneficiary of an IRA or an old 401k or whatever it might be, that person, instead of having that go throughout their lifetime and taking small amounts at a time per year, that now has to be withdrawn within a 10-year period. And that's really impactful. Okay, so what really happens, and we've already seen this, is we've got people who typically lose their parents while the beneficiary, the child, is in their highest earning years. I mean, that's just age-wise, that's what usually happens. So they're going to be taxed at their ordinary income level on any withdrawals they make on that inherited IRA, and they must do it within 10 years. It doesn't have to be every year. It can be one lump sum in 10 years, but there's a lot of tax strategy that comes into play. So again, nothing on this act that touches that or changes that, but that has been a big change recently. Adam, does vesting impact the employer Roth contribution?
Again, the legislation is still a little new, so that's something we're looking into. But I believe on the catch-up contribution or the employer match, if you choose to take that as Roth, that must become vested because you've already paid the taxes on that. So I'll defer to our compliance team for the specific answer once all the details have been ironed out. But I do believe I remember reading that.
Okay. I'll throw one more your way. Does the Roth catch-up provision kick in after $145,000 is reached in a calendar year, or is it based on projected annual income and applicable immediately when the plan year begins?
So it is based on prior year compensation.
Okay.
That would certainly be a little difficult if we had to guess year by year, where you think you might end up by year end.
Okay. And give me 1 second, just reading through a couple of these questions. Okay. And the last one, can you simply reinvest the inherited IRA RMD and avoid taxes by doing so? You cannot. So you have to take that inherited IRA, excuse me, when you take that required distribution from that, that's going to be taxed to you. There's really, Adam, as far as I know, there's no way to avoid that. You can certainly reinvest it and have that keep growing in a non-retirement vehicle, but you will be taxed on that.
That was the gotcha provision from Secure Act 1.0, and where the government raised all the money by shrinking that lifetime stretch provision to just 10 years. They're able to
Yep.
recognize taxable income a lot sooner. So
Yep.
no way around that.
That's right, unfortunately. All right, let's get back to it, and we will get a few more questions in shortly.
So Zach, 529 rollovers to Roth IRAs, that wasn't something that was part of the original legislation. Perhaps can you explain what a 529 is, and what Secure 2.0 is going to change about those?
Yeah, so this is actually a pretty big one. A lot of times in our financial planning, we'll deal with people who have had the fortunate situation where they've saved through a 529 vehicle for college for their kids and scholarships or what have you. They didn't need them. So what happens at that point is you can either use it for another qualified beneficiary, or you can pull it back to yourself, and you're going to be taxed on that growth. Plus, you're going to face a 10% penalty for not using it for qualified education. So again, always a tax strategy in this, but a lot of people say, well, I don't want to do that, right? It just doesn't make sense financially. And so what you can do here now through this act is you can have a lifetime limit of $35,000 transferred from that 529 to that designated beneficiary in a Roth IRA. So didn't need help in college, or maybe just didn't need as much help in college. So now that money can really kind of help them as they start into the workforce and start saving for retirement. So there is still an annual contribution limit on this of $6,500 going into this, and that can be done over a period of a few years until you reach that lifetime threshold of $35,000. Adam, I think you also asked, what is a 529? A 529 account is an account that's designed to be used for higher education purposes. It can also be used for private education prior to college now, up to $10,000 per year. It's a really good vehicle. It's something that's specific to college. It's something that some states you can actually get a tax break by putting money into it, but for the most part, it's money that's going to grow tax free and come out tax free once you do pay for college for those funds. We typically prefer that over what you might know as an UTMA account or an UGMA account, where that money is going to go to the child at their age of majority, be it 18 or 21, depending on the state. So we like this because this has to be used for college versus just a pile of money going to somebody at that age.
And Zach, there is that stipulation that the account has to be in existence for 15 years. When I was first reading through this, I thought this could be another loophole, kind of like backdoor Roths, where maybe you fund a 529 and then immediately move it to a Roth IRA. But that provision of having the account in existence for at least 15 years probably negates that.
Okay. And I just got a question in about what we're speaking about now does not take effect until 2024. I'm not sure if that was applicable to this slide or a previous slide, but we are going to, I believe, send this slide deck out. Don't hold me to that, but reach out if you have questions. But again, in the titles of each of these slides, you're going to see the year in which this will take effect based on the act. Is that right, Adam?
You got it.
Okay, good.
All right, so I think this is probably going to be one of the most popular provisions within Secure 2.0. Again, we're making some changes to catch-up contribution. So Zach, can you walk us through what that looks like?
Yeah. So current catch-up limit, as you see, for those that are 50 plus is $7,500. And a new tier will be created for this, and it's going to allow for a greater catch-up contribution. The ages that you're allowed to do this are ages 60 through 63. I guess that's a bit random, Adam. I would have thought that 65 being the normal retirement age, maybe it would have been a little bit closer to 65, but maybe there's a reason for that you know of and I don't.
Yeah, the draft version of this legislation actually had that second tier beginning at from 61 to 64. So that did get changed in the final version. Why they chose to cut it off at 63, I'm not quite sure. I thought 64 made a little bit more sense, just since that is butting right up until, the normal retirement age for most folks of 65. But perhaps they wanted it to start with, your 50s, you're eligible for this tier, and then once you enter your 60s,
Yeah.
here's the second tier.
Yeah, so probably a bit arbitrary, but yeah, good point. And then Adam, good job kind of highlighting what this looks like today. So right now, if you were 50% higher, again, you'll see that this begins in 2025 at the top. As of right now's numbers, you could contribute up to 11,250 instead of the $7,500 that we can currently do today. And Adam, I guess going back to a previous slide, this will anyone who's making more than $145,000, this will have to be Roth, correct?
It will. And one of the most common questions I've seen raised is, well, what happens after 63? Which catch-up tier do you fall into? Is it the first one? Is it the second one? What do you think, Zach?
Say that one more time.
So after age 63, when you're 64, 65, which tier
Yeah,
of catch-up contribution are you going to be in?
good question. And right now, I guess maybe there's going to be some more clarity. Perhaps Secure Act 3.0 will be on the horizon and define that. But I guess you're going to go back to this ordinary catch-up bracket that's currently $7,500. But we could see more on that in the future. Adam, I'm going to kick this one back over to you. This is a lost and found database that actually might apply to some of us on this call. Perhaps we had jobs in our 20s and bounced around a little bit and maybe had some old 401ks out there we didn't know about.
Yeah, so when I've worked with participants, a lot of common question I get is, hey, I worked for this company 20 years ago. I'm pretty sure I have an old 401k, but I don't really know where it is or how to track it down. Perhaps that company's changed providers since you've worked there and lost track of who it's with. And so they said, is there any sort of way I can search and find out if I do have that old 401k? And prior to Secure 2.0, the answer was no. The best advice I could give was, look at your tax return, your W-2s. In that box, I believe it's 12D on your W-2. It'll show if you made a retirement contribution during that year. And so you could go back to your HR professional and say, hey, I think I have an old 401k plan. Who's it with? Let me contact them. And so you have to do quite a bit of legwork. So this would really simplify that, where I presume that this database that the government will create will allow you to go in and enter your social security number, maybe a few other pieces of information. And just like those unclaimed property databases that the state of Tennessee or other states have, identify, do you have old 401ks out there, and help you consolidate them, make sure they're being managed appropriately. And so this is going to be a great solution for those folks. One thing I'm going to be curious about is, how does the government get that information? Are they going to be relying on providers like us to then do an upload at the end of the year saying, here's all of our socials, here's their balances? I'm not sure exactly how this is going to be created. And that 2-year timeline might be a little soon. We'll see if it gets enacted in time, but the Department of Labor is instructed to have this up and running within the next 2 years.
How do you know that it's line 12D? What is wrong with you?
Well, I do my own taxes each year, and so
There you go.
I might have looked it up before this call just to make sure I was looking at the right one.
Got it. And last one on this section, let's not spend a lot of time on this because, as you see, it's not applicable till 2027. And I think we're really kind of lacking some information on this. But just a quick spot, Adam, on the Savers Credit and the Savers Match.
Yeah, so right now, low-income individuals are eligible for a credit. It's up to $1,000, $2,000 if you're married, where basically you can get money off of your taxes if you make a retirement or IRA contribution. What we've seen in practice is it's rarely utilized because the credit's non-refundable, meaning you have to have a tax liability in order to get that credit. It's not going to just give you extra money if you don't have that tax liability. And so the government realized this and changed it with Secure 2.0, where instead of getting that tax credit, you're going to get a government match. That match is 50% up to $2,000. So to say that simpler, the government could give you up to $1,000 annually if you make that retirement plan or IRA contribution. And it's going to be regardless of your tax liability. So it's fixing kind of that issue that we saw with the Savers credit. Now, what's going to be interesting here is, how is the government going to know that you, Zach, have a retirement plan with the Trust Company of Tennessee? How is it going to know to an individual they have that IRA out there? I'm curious how they're going to build that pipeline to then send the funds once that contribution has been made.
Yeah, and again, with this starting in 2027, I'm guessing we're going to get more clarity around this in the time ahead. So once we know more, I think we can share more.
Definitely.
So before we move into part 2, again, we've got Joanna behind the scenes who's going to launch our second poll question. Anyone who is seeking CE credit through SHRM or CPE, please make sure you answer this. To anyone else, why not? They're kind of fun. Throw an answer in there. The poll is open. Adam, I still can't see it, which is totally fine because you can, and you can read it off for us.
Sure. So it's, as an individual, which of the following changes is most important to you? Option 1 is, I'm happy my RMD age will be pushed back. Option 2, I like the option to receive employer match as Roth. Option 3, I don't like being forced to make catch-up contributions as Roth. Again, that's over if your income is over 145,000. And then saving more through the second tier of catch-up contributions. Zach, what do you think it'll be?
Maybe C, although I'm not a good test taker and I just always guess C. So I'm going with that one.
My money is on the fourth one, so we'll see what everyone thinks.
And Adam, while you are doing that, a couple more, I'm sorry, there looks like we're sharing poll results. So if you don't mind taking us through that.
Yeah, so neither of us was right. It was actually the first one. I'm happy my RMD age will be pushed back. That's roughly a third of the vote, followed by, I like the option to receive employer matches Roth.
Yeah.
Good stuff.
Interesting. So there you go. To the providers on the call, the Roth piece, that's going to, get the advisors in, make sure they're talking to people, and make sure they're explaining. But it also, to those of us who do work within 401k plans, maybe that's something we can or cannot provide. Maybe it's something we need to really think about providing. So real quick, a couple more questions that came in. What salary level is considered low income, Adam, from that last slide? I don't know if we have that defined, do we?
So it does vary based off of if you're filing single or married filing jointly, and I don't have those numbers top of head, but
okay.
That's certainly something we can follow up on if you'd like to send us an email.
Okay, got it. And another question says, when you mentioned the $10,000 for private school prior to college, how long does it have to stay in the 529 before using it for private school? To my knowledge, there is no requirement as to how long it has to be in there before it's paid out for educational purposes. Adam, I don't know if you have heard differently on that.
No, I believe you're right with that.
Okay. And just scroll one more second here. Okay. Let's move to the next one. Adam, I'm just trying to get back to my screen. Give me 1 second here. And here we go. New and enhanced tax credits. Again, this is going to apply to retirement plans. Adam, take us through this.
Awesome. So if we have any folks on the call that don't currently have a 401k plan but are thinking about offering one, this is really going to be beneficial to helping people establish retirement plans. And so one of the big issues that Congress was trying to address is roughly 50% of Americans don't have access to a 401k plan. So how can they promote wider usage of retirement vehicles? So under Secure 1.0, they introduced some tax credits where basically you could get 50% off the administration costs, up to $5,000 for 3 years. The technical definition is $250 per non-highly compensated employee. So if you made under $150,000, you could get $250 per employee that meets that threshold, subject to that $5,000 cap. You could get an extra $500 per year if you added automatic enrollment. So your total credit that you could get would be $16,500 if you did both over the 3-year period. Now, Secure Act 2.0 kind of enriched those credits, and rather than have 50% off administration costs, they upped that to 100%, meaning you can realize the same credit without having to have the same cost that you would have under the first Secure Act. That $5,000 maximum still applies, but the Congress has been really generous with this second credit. It's totally separate, and this will reimburse the company through the form of a tax credit for the cost of employer match. And so you can get a tax credit up to $1,000 per employee. Again, notice the threshold here with income under $100,000. and then equal to the applicable percentage of the employer contribution for 5 years. So there is a phase out where the first 2 years you get 100% credit of what you matched employees. Beginning in year 3, that drops down to 75%, year 4, 50%, and then finally year 5, it tapers off at 25%. But if you're kind of on the fence about starting a 401k plan, this could really help push you over the finish line because you can get a tax credit back on the provider costs, and you can also get a tax credit on what you're matching to an employee, and most of it could just could be paid for through tax credits.
Yeah, I mean, it seems like they're sort of taking a parental approach, as they sometimes do in this, to try and encourage everyone to contribute and contribute more to retirement. And it seems like this is probably one of the pushier things they've done in trying to enforce that.
It's interesting you used the word parental because we're going to see a couple provisions here in a few slides that definitely fall into that parental camp. But the general theme has been, how can we get people to save more for retirement if they have access to a 401k plan, and if they don't, how can we get them access?
Yeah. And moving to the next one, Adam, this is I think a quick one, but we do have our HR people and our plan sponsors, if you will, on the call. How big of a gift card can they give me for contributing to our 401k plan?
Well, I don't know how much they'll want to give you for contributing, Zach, but the definition here has been de minimis, which is pretty broad, pretty vague, and so we will need further clarification or guidance from the IRS on this. But you see both of these provisions here weren't part of the original draft form of the legislation and kind of got added in last minute. But I am glad that they added this de minimis financial incentive, because a lot of times would go out to clients, companies, and they'd want to encourage participation and do gift cards because of it, not realizing that that gift card has to be included as part of an employee's compensation that requires corrections. And it's just kind of a complexity that doesn't need to be there. And so this legislation just kind of removes that hurdle, allows plan sponsors to do it. I would imagine something in the $25 to $50 neighborhood probably falls under de minimis, but again, we're probably going to need to get further guidance from the IRS.
Yeah, Lara and Ashley, that's not going to cut it. It's going to need to be more than $25 or $50. So I'll talk to you offline about that one. Adam, this is the big one. Student loan matching. Go ahead.
And before we dive into this one, there's actually one other that I want to cover.
I'm sorry. Yeah, sorry.
And that's the employee certification for hardships. So I was actually surprised that this one made it in. This is certainly going to alleviate our work here at the Trust Company and other retirement plan providers, and that before Secure 2.0, there was only certain criteria that met the definition of a hardship. If a participant was facing eviction, had high medical bills, they could take those funds out of their retirement plan when they otherwise couldn't. And the employer or the provider needed to certify that you met that definition. But under Secure 2.0, essentially plan administrators can rely on employee certification. And so that's going to ease administration, but I do wonder if that's going to create an unknown tax situation for individuals, because they might not know what qualifies and what doesn't.
Yeah.
And I imagine most are going to self-certify they meet that definition, which could introduce some problems for them should they get audited. So definitely going to provide some administrative convenience for providers and for companies, but I do wonder if that's going to get some participants into an unknown tax situation into the future.
Yeah, that seems dangerous. Yeah, I think I'd rather, as a provider, have the responsibility of helping them through that than trying to have them figure it out on their own, but we'll see what that leads to. And Adam, now let's jump into the big one. I think for a lot of companies, so you've got, we're all trying to hire people, and you're hiring people in their 20s or 30s who are still paying off student loans from school, and it's a big hurdle for them. And so this act is actually trying to tackle that as well.
Yeah, so this has been really popular since a company named Abbott Laboratories wrote and got a private letter ruling back in 2018. And essentially what they found was, they're a pharmaceutical company. They employ a lot of engineers, those that require those advanced graduate level degrees and often have a lot of student loans. They found a lot of their employees weren't saving in their retirement plan because they were paying down student loans. And therefore they were missing out on a relatively generous contribution from Abbott. The way their plan worked was if employees put in 2%, Abbott would give them 5% back. And so employees couldn't afford to save the 2% in their company, and therefore were missing out on the 5% contribution from the employer. So what Abbott said, they wrote to the IRS and said, hey, if we can demonstrate employees are putting at least 2% towards their student loans, can we still give them that 5% contribution in the 401k plan? And to everyone's surprise, the IRS actually wrote back and said, yes, we can, but it's only available to your plan because you went through the time and expense of doing this private letter ruling. Well, it's been so popular that this provision is now expanded to everyone. It is an optional provision, so you can adopt it or not. But essentially, if you can demonstrate that your employees are putting whatever percentage is applicable, in your plan to get the full match towards their student loans, you can still give them that match within the 401k plan.
Yeah, so probably a lot of questions on this. There's going to be a lot of figuring out to do, if you will, in the next 12 months for people like us about how this will all work operationally. But it's going to be a really attractive feature, I think, to a lot of companies for obvious reasons. And Adam, before I jump to the next one, just a couple of questions that came in. The first one is the question on the, I guess it was the 529. It said it applies to accounts in existence for 15 plus years. Does that bullet refer to the 529 or the child's Roth account? That does apply to the 529 account, not the Roth.
It does.
Okay.
And Zach, before we leave this one, I think
Yeah.
one interesting thing to note is, if I'm putting my plan sponsor hat on, how are you as a company going to know whether these employees have paid down their student loans? And so I've seen a couple different ideas out there. Some could be employee self-certification, where perhaps you as an employer send something out to employees saying, hey, let me know that you've put at least 2%, 5%, whatever, towards your student loans. Based on the popularity of this provision, we actually did a webinar a while back with a company called Vault. And so another option is you could hire a third-party provider where basically they set up a portal where employees can give read-only access to their student loans. And then for a fee, companies like Vault, Tuition.io, there's others out there, can then report back to you, the employer, here's what employees have done. So that could be another option. It would incur an additional fee. So glad this isn't effective until 2024 because there's certainly some considerations that are going to need to be worked out between now and then. But one good thing for those that are familiar with plan testing and what that entails is that you will be able to test these folks separately for purposes of the ADP test. And so that's going to clean up one consideration that a lot of us were wondering about. Hey, how would that even work from a compliance or administration perspective?
Yeah. Before I get too far past this slide, a previous slide, Adam, let me just throw a couple questions that came in your way. What if you started a 401k in 2022? Do you get a 50% credit for 2022, but get 100% credit for 2023 and 2024? Or do we know that yet?
That's a good question. I believe I have seen that those tax credits are retroactive back to any plans from 2019 that took advantage of Secure 1.0 tax credits. But for final determination, I'd consult with your CPA.
Okay, got it. Sorry. Our HR person just said, can the trust company give gift cards to everyone except for Zach Hurst? No? Okay, and then one other one on that topic. Let me just get back to that. Here we go. Do the new and enhanced tax credits provide any benefit to nonprofit companies?
I believe that does apply, but again, these provisions are so detailed that we're still digesting them and looking into the specifics. So that's something we can follow up on if you'd like to email us.
Okay. And Adam, last one before we move on. This one does apply to the current slide. It is if the employee is already contributing to their 401k and paying a student loan, would that increase the match? And I believe this is just clarity around. I think the rules on the match still have to remain the same. It's just part of it's going to be directed towards student loans, correct?
Yeah, so if I'm understanding correctly, the employee is contributing to the 401k and therefore receiving the match, but also paying down their student loans.
Correct.
So in that case, that wouldn't change the match they're getting. But then I would add that student loan matching provision is optional and requires plans to adopt or not adopt. So that would, your plan would have to adopt it for it to be effective. And then also it's not effective until 2024.
Great.
But for that individual, it wouldn't change anything.
So another interesting piece here. This is some changes that really go beyond just saving for retirement, and actually maybe even a bit counterintuitive to that. But starting the law now is starting to get into emergency fund savings for employees. So Adam, what does this mean?
So you brought up parental earlier, and I would say these two provisions definitely fall in that parental or paternal point of view. And so you've probably read all the studies just as I have, Zach, that nearly half of Americans would be hard pressed to come up with $1,000 or more should an emergency happen. And so really these provisions are trying to address that situation. Two distinct provisions. The first one, emergency sidecar savings. This is optional. And it would allow non-highly compensated executives, so that is anyone who makes less than 150,000, to save up to 2,500 in a Roth-like account for rainy day situations. Now, plan sponsors could impose lower limits than 2,500 if they wanted, but 2,500 is the threshold out there. And so how this would work, practically speaking, is there would be a different money source tied to your 401k plan. It would look just like a Roth 401k, and participants could contribute to that first, fill up that bucket. That would still be eligible to get them the employer match. Plan sponsors can auto enroll, but the cap on that would be no more than 3% of salary. And so once that $2,500 bucket is filled up, any further savings could go into the true Roth 401k account, or you could cease those contributions if the purpose for the employer was to only do the emergency sidecar account. Therefore, any distributions from that account would be penalty and tax-free. And the caveat would be anything invested in this account would have to be invested in something very safe and conservative, like a money market, stable value, something like that. So that's an optional provision. But then the next provision would permit penalty-free early withdrawal distributions up to $1,000 for emergencies. And so, again, neither of these were in the first Secure 2.0 draft, but did make it into the final bill. But this second one is pretty broad, and it's defined as anything unforeseeable and immediate financial needs. So pretty much anything short of I want to go to the Orange Bowl and watch the Volunteers win, I think would qualify. And so, you could get into, is that appropriate? Is that right? But the way this provision would work is you could have only one distribution is permitted per year. Employees can then pay that back into the account within the next 3 years. But a caveat there is that you cannot take any further distributions until that initial distribution is repaid over the next 3 years. So if you don't repay it, you wouldn't be able to take another distribution until year 4.
But if you don't pay it back, it's still penalty free, correct?
Correct.
Okay. Yeah.
So
yeah,
go ahead, Zach.
I was just going to say these are, a lot of big decisions for plan sponsors in this, because you're talking a lot about, you may do this, you can do this. It's just going to take some time. You and your committee, you and your providers talk through this, what makes most sense for your people, what can you realistically do for your company, and I think, Adam, both these fall into that category.
And I do really like Congress's intent to try to help these folks that aren't creating these emergency savings accounts on their own. I think that's a very noble intention. But one perhaps unforeseen consequence of this could be that participants are looking more and more to their retirement savings as that first look for when emergencies come up. And Zach, you and I always preach that retirement is for the long term. Don't tap your 401k if you can avoid it. That should be your last resort. And so I do wonder if provisions like this are going to make 401k more top of mind for participants, even beyond these provisions. Maybe does it spur more loan activity? Does it spur more hardships, especially now that employees can self-certify that they qualify?
Yeah, good point. And then we're going to get even more confusing to people here. We've got yet another K to throw out there through this act.
Yeah, so a lot of different retirement vehicles that'll be available to plan sponsors. This new one is a starter K. Of course, there's the traditional 401k, 403b, 457. There's also SEP, simple IRAs, and even IRAs. So a lot of different vehicles. But this one was really intended to address that half of America that doesn't have access to a 401k plan. A lot of times, some of the barriers are the required testing, the government regulations that come with a 401k plan. And so with Secure 2.0, they said, hey, let's take away some of that complexity. There won't be any top heavy or non-discrimination testing. But as a result, we're not going to give you as generous of a contribution limit. Zach, you mentioned individuals below age 50 can put up to 22,500. With this new starter K, you'd be limited to the IRA contribution limits of about 6,500. So employer contributions wouldn't be required, meaning you could just set it up for employees to contribute, and it would have a bare bones expense, but also kind of a bare bones contribution ability relative to 401k plans.
I'm just thinking through the advantage of this, Adam. I frankly, I don't see a lot of advantage to this, but I guess if somebody does not qualify for a deductible IRA, perhaps this is a way they can contribute to retirement at that level. I mean, is that sort of the one benefit I'm thinking about here?
Yeah, that could be it. And I'd say really the benefit here is waiving the top heavy and non-discrimination
Right.
testing. And so this probably makes sense for your, mom and pop company that has a couple employees and wants to do something, but might not be ready to offer an employer contribution or need those higher contribution limits that you can do in a traditional retirement plan.
Okay. This one's pretty straightforward. There's an increase in force out limits if you just want to touch on that.
Yeah, so right now, if a terminated participant, terminated is the key word, if their balance is below 5,000, you can auto what's called force them out of the plan, either through a rollover or a cash distribution. And so inflation has occurred. And so Secure Act 2.0 increased that threshold to 7,000. And so if you do have a lot of terminated employees in your plan, this will allow you to force out a few more of those, which can be pretty beneficial if you're coming up against that audit limit of 120 participants. Perhaps it could keep you under that audit threshold for an extra year or two.
Yeah, good point. Got a couple people I work with here who are going to be very interested in that. So it's good. And this one is a simple to safe harbor. This is going to be, simple IRAs or simple 401ks are good vehicles. They're good kind of starter vehicles for some companies. Adam, they're a little bit tough to get out of, and I think this changes that.
Yeah, so we don't see simple IRAs as popular as 401k plans, but nonetheless, there are plenty of companies out there that have them. And one of the big drawbacks was always if you started it, you would only be able to terminate it at year end. And so there would be a big rush in the fall for any plan looking to make that switch to a 401k plan or 403b plan to do it during that specific time period. And then further complicating matters, if a participant, not the plan, if a participant had been in that simple IRA for less than 2 years, there would be a penalty for them to roll over their balance to that 401k plan. And so Secure Act 2.0 gets rid of both of those headaches and basically says you can transition at any time and then waives that 25% penalty that existed prior.
This is a big one. So I guess, again, probably in the last 5 and 10 years, this auto enrollment has become pretty popular. Probably some pros and cons to this, but now this might be a requirement, it looks like, Adam, for newer plans. Is that right?
Yeah, so let's first talk about what automatic enrollment is. So the way most 401k plans have worked historically is you'd have to opt in to participate. So when you get hired, you'd have to say, I want to save 6% of my pay, and I'd have to fill out a form in order to participate. Automatic enrollment is the reverse of that, where the plan will say, unless you give us this paper telling us otherwise, you will be enrolled at 6%. And you always have the opportunity to opt out, but it's a behavioral finance concept that has really shown that by removing that hurdle, you're going to get a lot greater participation. And typically around 93, 94% of participants that are auto-enrolled do not opt out. So again, going back to Congress's motivation, they're really trying to encourage more people to save in retirement plans. automatic enrollment can be a great way to do that for some plans. And so what this provision is going to basically state is that beginning in 2025, any newly created retirement plans will be required to automatically enroll participants. And if you've seen any headlines around Secure 2.0, this is probably the one gaining the most attention, just because it is going to be such a big change. And a lot of people talk favorably about it. At the trust company, we love automatic enrollment, but for certain plans. And so one of the things that I think is going to be interesting is, if your company has high turnover, this could actually be a little bit of a frustration for you, because you think you enroll that participant, they work there for 6 months, a year, maybe they gain $800 in their 401k account, but then they terminate just due to the nature of that industry. Well, then what are they going to do with that $800 balance? Are they going to have to clean it up, roll it over? So there could be some friction there, but essentially, again, this will be required in 2025. Employees will have to be auto-enrolled between 3 to 10% of pay. Employees must be allowed to unenroll within 90 days, and then auto-escalation, increasing their contribution by 1% each year until it reaches somewhere in the neighborhood of 10 to 15%. So there are some exemptions here. So any plans established before 2022 will be grandfathered. You will not have to add this, but if your plan was established after 2022, you will have to add it by 2025. Simple plans will be exempt, governmental or church plans, if your business has been in existence less than 3 years or you have 10 or fewer employees.
Yeah, this is another one where it's just going to take some time to figure out parameters around this. You think about salary thresholds that we've talked about in some of these past ones. This one, Adam, it's more like this 90 days to unenroll. There's just a lot of trigger points in here that need to be tracked, which is fine. It's just going to take some prep work on this. So we've got, it looks like 2 years for this one.
And then any of our plan sponsors, this will require a little bit more due diligence, on your part to make sure those people are automatically enrolled, because if they're not, then there's corrections that need to occur. And so again, in general, we're big favors of automatic enrollment, but for certain companies and some this will work great for, and some it might be a little bit more complicated.
Yep. Last one, Adam, before we try to get to one more question, perhaps. This is a benefit statement. Perhaps, I guess in the past, paper statements may have been required more regularly. It looks like that's being pushed back.
Yeah, so we've talked about a lot of great provisions today, and we're going to end with kind of a simple one. But essentially, the trend is moving towards electronic everything. And so if you have those participants that haven't yet elected e-statements, currently they're likely getting quarterly paper copies. So this would eliminate the need to do quarterly paper copies, and you'd only need to give them that paper copy once per year. The other 3 quarters could be sent electronically. The one caveat here is if that participant has already elected e-statements, they can continue getting e-statements for all 4 quarters. No need to go backwards and send them a paper statement once a year.
Got it. Joanna, we have one more poll question. Let's take care of that one. One more little fun activity here before we start to wrap this up. And Adam, it looks like it's open. Perhaps you can read that one off for us.
Sure. So as a retirement plan sponsor, which of the following changes is most important to you? We have tax credits, student loan matching in retirement plans, emergency sidecar savings, and required automatic enrollment.
And speaking of the emergency sidecar savings, somebody asked, if I can get back to this. Adam, they do need to put a provision in, or a plan amendment to adopt that, correct? The $1,000 emergency savings?
Correct. That is an optional provision, and that will take action in form of a plan amendment to enact. But again, it's not required for a little bit, so we'll have some time to make those changes.
Okay. I can't see it, so what do we have?
Interesting. So the result is new tax credits was the most important.
Huh.
And I would have thought that would have fallen towards the bottom if for much of our audience that already has that retirement plan, but that is followed shortly by required automatic enrollment, and the student loan matching and emergency sidecar savings were the final 2, both below 20%.
Gotcha. And we've got 1 minute. So Adam, I know we have another important one coming up. This is going to be more for our plan sponsors on the call, for those who are involved with corporate retirement plans, but we do have another webinar coming up. Looks like February 2nd.
Yeah, so it's certainly been a rocky year for markets in 2022. We had stocks down 18%, bonds down 13%. So, we're really looking at what changes should we make in 2023 to best position our clients' portfolios for the future. And so we're going to be updating our capital markets, giving some thought as to where we think things could be going over the next 10 years. And so we'll be discussing some of those changes and kind of our outlook on February 2nd. So feel free to register if you'd like to join that call.
Great. I believe we have some exit questions once we wrap this up, which we will do right now. Thank you all very much. We appreciate you coming on. Happy New Year to everybody. Adam, thank you for your expertise, and we will plan to see many of you on February 2nd.